Guide. Performing due diligence in mergers and acquisitions, M&A. Transactions. Introduction. Due diligence is a critical process in mergers and acquisitions, M&A. Transactions that involves conducting comprehensive investigations and assessments of the target company's financial, legal, operational, and strategic aspects. Effective due diligence enables the acquiring party to evaluate the risks, opportunities, and potential synergies associated with the transaction and make informed decisions. In this guide, we'll explore the key steps involved in performing due diligence in M&A transactions. 1. Establish due diligence objectives. Define the objectives and scope of the due diligence process, outlining the key areas to be evaluated, such as financial performance, legal compliance, operational efficiency, market positioning, and cultural fit. Tailor the due diligence approach to align with the specific goals and requirements of the M&A transaction. 2. Assemble due diligence team. Form a multidisciplinary due diligence team comprising professionals with expertise in finance, accounting, legal, tax, operations, technology, human resources, and other relevant areas. Assign roles and responsibilities to team members and designate a project manager to oversee the due diligence process. 3. Conduct preliminary assessment. Gather preliminary information and documentation about the target company, including financial statements, corporate governance documents, contracts, regulatory filings, intellectual property rights, and operational reports. Perform initial analyses to identify potential red flags, risks, and areas requiring further investigation. 4. Perform financial due diligence. Review the target company's financial statements, including income statements, balance sheets, cash flow statements, and financial forecasts. Analyze financial performance metrics, such as revenue growth, profitability, liquidity, solvency, and capital structure. Verify the accuracy of financial information and assess the quality of earnings. 5. Conduct legal due diligence. Evaluate the target company's legal and regulatory compliance, contractual obligations, litigation history, intellectual property rights, environmental liabilities, and corporate governance practices. Review legal documents, such as contracts, agreements, permits, licenses, and regulatory filings, to identify potential legal risks and liabilities. 6. Assess operational and strategic factors. Assess the target company's operational capabilities, production processes, supply chain management, technology infrastructure, customer relationships, and competitive positioning. Evaluate strategic factors, such as market trends, industry dynamics, growth opportunities, and competitive landscape, to determine the viability of the transaction. 7. Review human resources and cultural fit. Evaluate the target company's human resources policies, employee benefits, labor relations, organizational structure, talent management practices, and cultural dynamics. Assess the compatibility of organizational cultures and identify potential integration challenges or cultural differences that may impact post-merger integration. 8. Identify risks and synergies. Identify and prioritize key risks, opportunities, synergies, and value drivers associated with the M&A transaction. Assess the potential impact of identified risks on the transaction's success and develop mitigation strategies to address significant risks and enhance value creation opportunities. 9. Document findings and recommendations. Document due diligence findings, analyses, and recommendations in a comprehensive due diligence report or memorandum. Summarize key findings, highlight significant issues, and provide actionable recommendations to the acquiring party's management and stakeholders. 10. Communicate and collaborate. Communicate due diligence findings and recommendations effectively with the acquiring party's management team, board of directors, legal advisors, financial advisors, and other relevant stakeholders. Foster collaboration and transparency throughout the due diligence process to facilitate informed decision-making and successful execution of the M&A transaction. 11. Update and monitor. Continuously update and monitor due diligence activities throughout the M&A transaction lifecycle, from initial assessment to post-closing integration. Address any new developments, emerging risks, or changes in circumstances that may impact the transaction's outcome and implementation. Conclusion. Performing due diligence in mergers and acquisitions, M&A, transactions is a complex and multifaceted process that requires thorough investigation, analysis, and collaboration across various disciplines. By establishing clear objectives, assembling a skilled due diligence team, conducting comprehensive assessments, identifying risks and synergies, documenting findings, communicating effectively, and monitoring progress, acquiring parties can mitigate risks, maximize value, and increase the likelihood of successful M&A transactions. Embrace due diligence as a critical step in the M&A process and leverage it as a strategic tool for informed decision-making and value creation.